Hi, everybody, it's Dr. Robinson. This is the February 17th, 2024 meeting of the Money Masters Investment Club. Not a lot to talk about today. I think I've got a total of 3 slides, including this first one. So without further ado, let's kind of get to it. So the NAV, we had a pretty good week this week. A lot of volatility kind of returned to the market in a pretty good way this week. So pretty happy with the results. We're up, NAV currently at $36.27, so a total of 3.12% for the week. I kind of alluded to it earlier in the week when I was trying to catch you up on a previous NAV, but we were having a pretty good week. Lots of volatility came back. I wanted to talk to you a little bit about why the volatility came back and why I think we might be finally out of that VIX in the 12 and even the 13 range. VIX currently sitting right at 1424, still a little low for us for what we would like for maximum profit making, but on the way, and I think we might be able to keep it going in that direction. There's always a possibility it comes down a little bit more over the next couple of weeks, but I think as more and more investors realize that the Fed is almost unable to lower interest rates now, maybe till the end of the year. Originally, remember, we'd been talking that people had been thinking that interest rates were going to come down sometime in March. I've never been on that bandwagon. I was not on the bandwagon for May either. We've got another Fed meeting in May. I didn't think that was going to happen. I always thought it was going to be somewhere in September, maybe the early fall or late summer type of thing. But as of right now, I think that maybe even that is off the table for the moment. Now, again, we've got a lot of news that can come in before that. And it might be that the last couple of announcements we've had on inflation are anomalies. So we have to kind of wait and see. But given the information we have, I don't think there's any chance of a rate decrease rather, in March or even in May. So I don't think that's going to happen, and that's going to make the market a little bit uptight. We saw some activity this week in the market. It didn't make sense at times, I'll be honest with you. We had CPI number came out, the market tanked on that, but a couple of days later we were back at another record high. We got the PPI numbers, they didn't look good either. The market started at the opening bell to try to go up, and then about 2 o'clock it collapsed as well. So I think investors are starting to get the message that we kind of jokingly call it hopium. It's like a drug that they believe that the Fed is going to goose the market with lower interest rates. I think they're coming to the realization that if it does happen, it's not going to be until much later and possibly into 2025. I'm not saying it will be 2025. I'm just simply saying that the realization coming that it's not as good as the best of expectations that people had for March and May, etc. So originally, and I've said this before, the market had priced in 6 interest rate decreases, all at about 25 basis points each, but they had priced in 6 of them. Well, we now know that March is off the table, and so is probably likely. Again, things could change. Inflation could drop drastically from here, but given what we know right now, May is probably off the table as well. There's no way that the Fed would have the ability to do 6 more rate decreases for the year. So we know that some of those rate decreases are off the table. The question is how many, and there's no way to know in advance how many are going to be off the table. We just simply know that there's going to be fewer, and it kind of depends on what the data suggests going forward. And I don't think the data is looking particularly good. So in fact, let's look at a couple of things here. And it's just one more slide, nothing major. So I said volatility returned this week, and of course it did. We looked at a couple of different things. Our core CPI. Remember, when it comes to core is the CPI, by the way, is Consumer Price Index. Core looks at the price of things excluding a couple of important things. It excludes fuel or energy, which of course is gas and oil and things, and it excludes food. Now they exclude those things because those things are more volatile than the average type of things you see in stores or things that people buy. So if you exclude those, now generally we wouldn't expect, the trend has been fairly down, but unexpectedly it rose 0.4% in January, taking the inflation rate back up to 3.9. So we had been kind of making some good progress. Now remember, the Fed wants to get interest rates down to 2, or inflation rate rather, down to 2. And we had been making some pretty good progress. In fact, in some instances, we were kind of thinking the inflation rate was getting around 2.7, 2.6. And all of a sudden, we get a core rate at 3.9. Now, we do measure non-core as well. Non-core didn't come down as much, or didn't rise rather as much, but it still rose some. Um, it was offset a little bit by energy prices. Energy prices have been coming down. The price of oil has been coming down. You've probably seen that. It's been kind of trickling up a little bit as we get closer to the summer driving season. But at the end of the day, oil prices had been coming down fairly steadily, despite even all the stuff that's going on in the Middle East. But they had been coming down. But food prices are still sticky. So we did see some increases in food prices, but they weren't as much as the losses in or the decreases in energy. So when it comes to the non-core CPI, it didn't rise as much, but the one that the Fed pays attention to is the core CPI. Since it does exclude those two that are most volatile, you expect to see more consistency in this number, and this number spiked, and it kind of scared people. The market on this particular day, when we got this news, by the way, the market went down. At one point, the Dow was down 700 points on the day. It did come back a little bit. It settled. I think that day it closed out 500 points down. The S&P, the one we spend a lot of time watching and dealing with, it was down at 1.70 points and kind of came back a little bit, and it settled at, I don't remember, I think it was in the mid 50s or upper 50s or something, but it was still a pretty bad day. But over the next couple of days, the market kind of thought, you know what, let's ignore what happened here, and the market started climbing again. So over the next couple of days, again, we hit another record high 2 days later in the market. And then yesterday on Friday, we get our PPI numbers, which is a producer price index. Now this one, to me as an economist, this one's a little bit more important than the CPI. CPI is what consumers pay. That's what you and I pay when we buy stuff from, let's say we're going to buy a refrigerator from Home Depot or something. The PPI is from the manufacturers of the refrigerator. So what they're seeing is they're seeing increased costs for aluminum and steel and wire, copper, and all the things that they have to buy to make a refrigerator. So those prices are going up, and look at the price in the core increase there. That was up 0.6 in January. What that means, by the way, is if the PPI price in 1 month goes up like 0.6, you know that the following month the CPI number is going to have to go up. It's going to increase the cost of that refrigerator. So back in December, a refrigerator at Home Depot, and I'm just going to make some numbers up just to give you an illustration, refrigerator might have cost $1,000, but in January, because of the increase in the CPI or the inflation rate, it might be $1,100 or $1,200. Again, I'm just making numbers up, but it's going to be at a higher price simply because the cost of aluminum, the cost of all the things that go into making a refrigerator from the manufacturer are now higher than they were 30 days ago. Therefore, the price on the CPI level is going to be higher the following month. So next month, we would expect to see the CPI come up a little bit more as those producer prices come up. Now, sometimes it doesn't happen, and that's because sometimes the manufacturer or the producer of something will absorb some of those costs. But I think they're to the point where they can't really absorb those costs because a lot of companies, especially union companies that have unions, those companies are struggling a little bit because they've given such good packages recently. For example, with United Auto Workers, they saw an increase of 40% in their pay over a period of time. It's not all in 1 year, of course, but that increase in pay has to translate to higher prices automatically. So General Motors might be able to absorb a little bit of an increase in the cost of steel, for example, for a car, or the cost of wiring and all the other things that go into a car. They may be able to absorb some of that, but they're not going to be able to absorb all of it. But with the increase in wages recently and the lack of significant increases in productivity, it's unlikely that General Motors is going to be absorb much of that at all. So I wouldn't be surprised to find out the price of cars have to go up fairly significantly to offset those costs. Now, what that means in real terms, General Motors would know on a per case basis. But at the end of the day, we'd expect that the vehicle prices are going to go up again next month. So this is the kind of stuff that's going on in the market. The market yesterday, by the way, when we got this news originally, the market kind of still went up. The futures market came down, but when the market itself, when the cash market opened, the market went up and peaked at about 2, maybe 2:30 in the afternoon. And some of the guys and I were talking on the call, because we do the daily call. We were talking about how did the market come up on such lousy news. I was convinced the market was going to come down, and I told the guys at the beginning of the day, I said it may try to come up for a little bit, but eventually it's got to close down, especially going into a 3-day weekend. I did expect the market to come down, but by 2 o'clock I thought, man, I blew this. I was convinced this thing was coming down, and it had no intention of coming down. And then something happened at 2:30, and the market just collapsed. And in a matter of probably 5 or 10 minutes, the market ended up down 25 or 30 points for the day. So it was a pretty big drop from where we were. And we were up at that point 15 to 20 points. So if you think about it, it went from a high of 20 to maybe a low of 20 or 25. So you had a 45, maybe a 50-point swing between the high and low. I haven't looked at the actual highs and lows, so I'm kind of guesstimating where they're at. But again, a swing of 45 to 50 points on the S&P is a pretty big drop. And that drop all happened in just a matter of, in all honesty, I was in one of the trades, and it happened in really just 2 candles. So in 2 candles, this thing's collapsed the entire way. So it went up, 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 up all day for 6 hours, and then basically the last hour of the day, or 5 hours, the last hour of the day, the thing just collapses, and we lose everything we made during the day, and went back, and in fact we went back to below the open of the day. So it was kind of an interesting day yesterday, and that's part of how we had a pretty good day yesterday. So the last thing that's causing some volatility is retail sales. So we also got our retail sales numbers. I believe those came out same with the CPI. This to me is a more important number. Core CPI is not all that big a deal to me as an economist because I'm a macroeconomist. I don't like to look at necessarily stuff over a month-to-month thing. I like to look at things over an annual period of time, the big picture, so to speak, because there's always going to be those ups and downs of the little things. But retail sales is another way, and I think it's a better way of measuring GDP, which is the size and scope of our economy. Our retail sales collapsed by 0.8%. On top of that, they took away 0.2% that we had in December. So in all honesty, since November of last year, if you look at what's happened here in terms of the declines, we've had basically a 1% decline in retail sales, and that's such a good indicator of the economy. It tells me the economy is shrinking. So at the end of the day, this is a pretty big number. I'm not saying we're in the recession, by the way, because it takes much more data and much more time to determine whether we're in a recession. We're not in a recession. I'm not saying that at all, but there is a collapse or a shrinking of the economy. By the way, if you adjust it for inflation, the real decline, and this doesn't include the 0.2 from December, but just for the 0.8, so we say 0.8 was the decline, but if you adjust it for inflation, the real decline is actually 1.1%. So from a retail sales perspective, our economy actually decreased, got smaller, by 1.1%. Now, in economics, we say that, and everybody's been fighting it for a couple of years now because they don't like they want to redefine things. But historically, 2 quarters of negative GDP growth would be considered a recession. Now, this isn't GDP, but this is very similar to GDP in how we calculate it and what it tells us. So we've now got basically a period of time here where we've got 1.1% decline. Now, of course, we have to put this in context, what's happened over the last 3 months, because we do quarters. We had really strong quarters in November and December, so they kind of offset what we're doing here. But it was a shock in the economy, and it's a shock to economists to see that this time of the year where so many people are spending, we had Christmas in here, we have New Year's in here, lots of stuff going on, and yet the economy grew at a much smaller rate. In fact, it declined a little bit in terms of retail sales for the month. Now, it is only a month. We'd have to see a couple of more months of negative numbers to say that the quarter has been bad. But for the moment, that was a real shocker. Between these 3 things, we're starting to see the volatility spike in the VIX. For those of you who know, VIX is the volatility index is the main thing that we look for in how to trade, how long we can stay in a trade, etc. The VIX had come down into the 12s. That's where we struggled in late December. It's hard to trade. Of course, I was sick a lot during that period of time too, so I didn't trade a lot. But when the VIX is that low, there's just not a lot of trades you can do. and you certainly can't hold them for a very long time because the market just doesn't move that much. Stocks were at a high, and when a stock is at a high, it doesn't like to go too much higher unless there's some sort of news to push it higher. But since there's so many people interested in owning the stock doesn't come down either. So it kind of trades in a narrow range, and that's where we had been. As the market starts to see more volatility, that range starts to get bigger. So we've seen the VIX. Like I said, the VIX right now is at 1424. Still lower than what I would like. The kind of the sweet spot for me is somewhere around between 18 and 20. That's where we can get into a trade, hold it for a long time, and make a lot more money. The difference between the high and the low of the day is much greater. Therefore, there's better chances for us to make bigger profits. So I like it that way. Of course, a higher VIX also implies that stock prices are doing a lot of ups and downs too. So in your personal accounts, and a lot of retail investors, when you think about your IRA and your 401k, those kind of suffer a little bit because stock prices might be coming down a little further. But for what we do, we like the higher VIX and the higher volatility. And so far, that's what we've gotten. And you can see in the results. Last week, the VIX was in the 12 and 13 range, and we just didn't get that much, and it showed in our numbers. And when the volatility comes back, we can make some really good numbers. So I think it's going to continue. Again, the CPI numbers, PPI numbers kind of imply. Now again, it could be a one-off. It might be just an anomaly where next month they come back and say, the core CPI and the core PPI came down a little bit further than we expected next month, and that might put a rate decrease back on the table for May. I just don't see it. So at the end of the day, volatility return, that's a good thing for us, and hopefully we can keep it going. If we can keep the volatility going and get that VIX up into the 15, 16, and maybe 18 to 20, that would be the sweet spot for us, and we can make a lot of money from that. So other than that, guys, that's all I've got for the week. Hope everything's going well for everybody. I will update you again in a week or so, and see everybody who comes on the call. We'll see you on Monday. Enjoy your weekend.